This is the Rich Dad StockCast with Andy Tanner, the show that kicks 401ks in the asphalt and teaches you to be the master of your own stock investing domain. And here's your host, Greg Arthur.
Welcome to another episode of the Rich Dad StockCast. Now, one thing that Robert teaches us is the more people you serve, the richer you become. So one of the things Andy would love for you to do is to tell us how we can serve you better. Tell us what you'd like to learn on this show. So if you guys don't mind, let us serve you better by putting in the comments exactly what you'd like future shows to be about. And Andy and I will work on that.
For sure.
But this show is about one of the biggest investment strategies you'll ever hear. You'll hear it on the media. You'll hear it from financial planners, financial books, brokers. Everywhere you go, you're going to hear this strategy. And the strategy is called diversification. So before we get into it, I want to tell you what Warren Buffett says about that. He says diversification is protection against ignorance. Another thing he said is it makes very little sense for those who know what they're doing. And we're hoping by listening to this show or watching this show that you start to learn what you're doing and we can all be like Andy. But
I'm still trying to figure out what I'm doing.
Yeah, sure. My favorite quote of all time about diversification is from Mark Cuban. He says, very simply, diversification is for idiots. So with that, let's find out what Andy Tanner thinks about diversification. Andy, welcome to the show.
Greg, thanks for having me. And just a big, just an acknowledgement to everyone who tunes in and listens. It is so gratifying to hear the comments. So many people are complimentary. And as Greg said, our job here is to help you. And so it's just an honor to be here. And I so enjoy our conversations every single week. So thank you.
Thank you. There's actually a little greedy because I didn't finish Robert's quote. He says, the more you serve, the richer you become. So, hey,
yeah,
let's get rich, Andy.
Yeah, he gets that from Buckminster Fuller.
Exactly.
And,
one of his mentors.
The difference is Bucky says the more people we serve, the more effective we become. But
well,
rich,
it's all the same.
It is in reality. So diversification, you're right. That was, that quote by Warren Buffett, there's a lot to be said on this. The overwhelming dogma of the markets is, hey, invest for the long term in a well-diversified portfolio and hang on. And the first thing I was, and there's a lot of people that believe in that, titans in the industry. One of the people I read a lot and really listen to a lot that believed in diversification completely is the late John Bogle, who passed away not long ago.
Yeah, can I interrupt you?
Yeah.
One, I would like you to tell everyone who Vogel is, but do they really believe it, or are they telling you that so they can keep your money in longer? Because like you said, that part of that is keep your money in for the long haul. So what I'm asking you is, do they believe it, or is their greed showing?
Your timing of the question's perfect, because that's the perfect segue into the idea. Is I think there are people like John who believe it, and I think there's other people who don't. I think there's both. And John Bogle, who was the founder of Vanguard, so he was kind of a big deal. I think similar to American Express, I think it was his kind of a master's paper he wrote, and they turned it into a company. Same as Federal Express. It started out as a college thing that got like a C- on it. Next thing you know, it's actually worked.
Oh, that's cool.
But
isn't he like the father of mutual funds or something like that?
I don't know if he's the father of mutual funds, but he did create the Vanguard 500, which is a diversification instrument, right?
Gotcha. Okay.
But here's what I find interesting about diversification. If I'm going to have someone else do this for me, and I'm going to pay someone else to do this for me, there should be some advantage, or one would hope there would be some advantage over what I could do myself. I remember a story in U.S. News and World Report that I've kept in my files for a long, long time. And the title of the story is called When a Broker Leaves You Broke. And it talks about a couple named Richard and Margie Fisher. and he worked for an oil company, and things seemed really well. He had, a nice $300,000 portfolio. I don't know how you retire on that, but I guess he thought he could. And so he takes an early retirement, and he takes his money and gives it to an advisor. And the article says exactly this: who placed it in a fund that was indexed to mimic the market, which is basically a Vanguard 500 fund.
Okay.
And what I think is interesting about that, Greg, is how much skill, education, knowledge, and creativity is required to do whatever the market's going to do anyway.
Right, zero. So you're kind of paying for nothing.
Right. So this broker, his commission for moving them into the fund, for acquiring those assets under management, was 20 grand up front in his pocket, right like that. So why am I going to spend $20,000 to do whatever the market's going to do anyway? The S&P 500 is there. I guess if a person didn't have enough money to buy a few shares in each one, there might be some value to pooling mutually with other people to buy that index. But you're exactly right. It is essential in my view, or advisable in my view, to look at the other side of the coin. Well, what do I get for diversification? Well, I get my money spread around, basically, and that's what I get. And it's going to be what it's going to be, and it's indexed to mimic the market, and I don't have a lot of control over that.
Well, can I throw in one thing?
Look at the other side of the coin. Oh, go ahead.
Yeah. When Robert talks about it, he says diversification is great if you have no financial intelligence. So if you know nothing, go diversify.
I don't even know if it's intelligent if you know nothing, because if you know nothing, you can still buy the S&P 500.
Right. Fair.
I don't think it's great. I'll tell you who it's great for. If you look at the other side of the coin and you listen to that dogma, put yourself in that great big building on Wall Street, in that big fancy office. And everyone's sitting there saying, well, how do we get assets under management? How do we make money? Well, it's very simple. The more money we take stewardship of, the more money we have that we can charge fees for doing this diversification. This is awesome, because if we just diversify and say we're going to mimic the market, when the market falls, it's not our fault.
Right.
So keep your money in, and we're going to keep earning cash off a performance that has really no nothing about it, right? Absolutely no, what would you call, insight, creativity, work, even, really not much work.
Right.
So it is certainly the idea to diversify and hold on for a person's whole life, and just keep putting your 401k money every 2 weeks into their coffers. There's no question it's a benefit to them. I mean, it is a no-brainer. It's no risk for them. It's an infinite return for them because they have no money in the deal. The investor takes all the risk.
When you're saying them, you mean Wall Street.
Yeah, Wall Street's number one phrase is assets under management. It's the most important phrase I think there is there. And fees go along with that.
And that's when you look, they get the fees monthly, right? So the longer you keep your money, or yearly, the longer you keep your money and the more fees they're getting. And like you said, for doing no work.
Yeah, and Buffett talks about compounding costs. Not Buffett. Bogle talks about compounding costs, and his argument was nothing wrong with diversification, but you shouldn't charge a lot for it. So he would say if you have a fund that is not diversified and is supposed to be done with skill, and you charge these exorbitant fees, 2%, 2.5%, 1.5%. He says, no, come to my Vanguard fund at 50 basis points, and we'll diversify you, but we won't charge you as much because we're not doing as much. But more to my liking is I study both men. I love both men. I respect and learn from both men. Benjamin Graham, Warren Buffett's a mentor, talks about his book, The Intelligent Investor. And that book is really about two things. Number one, it's about temperament and how you approach it emotionally. And number two, it's a little bit about method. And what Benjamin Graham says, he says, very few people get excited about putting in the time to A, learn securities analysis, and B, do it. Now, doing it is not as tough as it used to be in Benjamin Graham's day, because now you have computers. I mean, Buffett in his office, if you watch the HBO documentary, he's got these big ledgers of, financials information that used to look as thick as a phone book, And Buffett just looks at those with nostalgia. He says, "Oh, I remember, reading through these and picking."
Right.
So there was a time element to really grind through and say, what is it? Let's talk about that method for a minute. One of the things Warren Buffett has argued is he said, let's say there were 100 companies. There's actually thousands. But let's say there were 100 and you have enough money to buy 10. Well, if you diversify and just diversify throughout that 100, picking 10 diversified, you're just acknowledging that you're going to pick up some stuff that is losing, that you're going to be buying less than the best you could try to buy, less than the best you could. Now, people always want a guarantee because they have jobs and they want that guaranteed paycheck. That doesn't mean Warren Buffett picks the best. It just means that he believes in doing his best to do so. Let me say it again. It doesn't mean Warren Buffett picks the best. Every year, there are companies that grow more than Berkshire Hathaway and more than companies Berkshire Hathaway owns. But he says, why would you not want to do the very, very best you could do? Think of it as picking a basketball team from the local high school. Maybe I just diversify. I get tall people, short people, fat people, skinny people, men, women, all different races. I'll do all this. Well, does a great basketball team look very diversified when you watch the NBA?
Not so much.
You got guys that are 6'7", not guys that are 5'1", very rarely. You have athletes, you have a certain body type, right? They're not diversified at all. Why? Because you want the best and you want to win. You're just going to do what's going to win. And so as you go to pick from the colleges, you're looking at statistics, you're doing analysis, you're watching film, you're seeing what their attitude is, what they represent, what they stand for. Are they a good kid? Are you going to wind up with a Len Bias situation, right? You want to find all these things out so you can pick the best team you can. That's called fundamental analysis. It's the first pillar of investing. Is when I tell my son, let's go find something, we have criteria. That does not guarantee that we've picked a winner. Things change in the market all the time. It does not guarantee. But you know what? I feel better inside saying, hey, the problem is when people try to predict the market, it's really not what it's not what Buffett's going to do. He's not looking at the stock price, predicting the stock price goes up. He's saying, look, this is a company that seems to have some pretty good products. And their numbers are telling me that people seem to buy these products. Their brand seems really, really strong. These guys got a moat around them. They got some protection. Their financial statement is in such a way that it seems like they have some financial strength and they might last for a while. He thinks that is a better way to avoid tragedy than just buying everything. You think about real estate, Greg, think about Kenny McElroy. Would he just arbitrarily buy 1,000 houses and hope some do well? No, he would do research. He would look at he looks at the demographics. He looks at, are people moving in? Are jobs getting more plentiful or less plentiful? It's data driven. And there was a man named Arthur Levitt, who was a former chairman of the SEC. And Arthur Levitt said something that I just thought was wonderful. He said, this generation of investors should be the most informed generation in the history of our capital markets. The ease of today's technology is not an excuse to do less, but an opportunity and a mandate to do more, learn more as individuals and as a country. I probably destroyed that quote, but I think it's pretty close to what he said.
We got the gist of it.
Yeah. So yeah, your opportunity, if you're listening here, if you go into diversification as a risk management strategy, which is what 90% of people say, this is what they will say. They will say British Petroleum. Remember BP?
Yep.
It used to be British Petroleum. Now BP stands for broken pipe, because in the Gulf of Mexico a few years ago, they broke a pipe and their stock went from 60 to 30 in a month. And they're going to say, well, if you had all your eggs in that basket, you just lost half your money. Well, if you bought the S&P in 2008, by the end of 2009, you lost half your money, diversified too. One's called systemic risk. One's called non-systemic risk. Listen very carefully to that jargon. Jargon is about learning new financial terms. Diversification does not do anything to limit or mitigate systemic risk. In fact, it enhances systemic risk. And so if you're sitting there with your, advisor and he's saying you got to diversify, say, well, great, thank you for wanting to protect me against non-systemic risks. What are you doing to protect me against systemic risk? Because when I look at the amount of money we're printing, I look at our Fed policy, I look at our fiscal irresponsibility, I look at our debt, I look at the illiquidity in the bond market, I see systemic storm clouds as well as non-systemic ones.
So let me interrupt, because when I want to make sure I'm getting this. When you say systemic risk, you're really saying
market risk.
Yeah, the whole market, so the whole stock market.
Yep.
And so generally speaking, the stock market, if one goes down, they're all kind of going down in the big picture. And that's systemic risk. And kind of the opposite of what you're talking about earlier is, instead of diversification, and I loved your basketball analogy, instead you want focus. So you want focus on what you see as the right stock. And in your case, the basketball was, you want to focus on the right type of player.
Yeah.
So focus is kind of the opposite of diversification.
It really is. And someone's going to say, yeah, but Mark Cuban bashes this, but look at all the companies he has. And Warren Buffett, he's diversified. He owns a lot of companies, not just one, right? Well, what is the focus on? The focus is on criteria. It's not a limiting, like Warren Buffett doesn't think of the motive behind Cuban and Buffett. He gets on the Shark Tank and he's presented opportunity after opportunity after opportunity. He's not saying, well, I haven't bought one for a while, I need to diversify. I think I'll just buy this because I have all my eggs over here. He's listening to that guy and he's saying, look, is there an opportunity to make money? Does this guy meet the criteria I have for investing? Great, add it to the pile, right? Add it to the pile. But they're very focused on, he doesn't diversify and just say, well, I guess why don't I just put a little bit of money in all of them? Every dude that comes on the Shark Tank, I'll just throw a little bit of my money at him, and some of them are going to work out, some of them are not, but I hope the ones that work out outnumber the ones that don't. That's not his modus operandi at all. They have very specific criteria. They're going to be intelligent. And risk management, for Mark Cuban, he made one of the worst investments ever, like the worst one you could ever make. He had all his eggs pretty much in a company called broadcast.com that broadcasts baseball games all over the world, sporting events. And he traded that company, ownership for it, for Yahoo shares of stock. Yahoo bought that company. Well, Yahoo stock went from $100 to $5.
Oof.
And they say, well, Cuban, how come you're still a billionaire? He says, well, it's because I didn't diversify. I had put options. I bought options to protect myself. Look, you wouldn't just, if you wanted to protect your automobile investments, you wouldn't buy 300 cars and hope more crash. You would buy as many cars as you wanted to have. They would fit the criteria of the cars you like, but you would insure every single one individually.
Which is what Cuban did with the puts.
We did a year-end summary of our Mentor Club, our paper trading club, where people learn to paper trade and practice every week. The most lucrative investments we had that paid more than any others in 2020 were our hedges, where we would go out and we would go short index futures against the S&P and the E-mini S&Ps. And those exploded with value when coronavirus, dropped the market. They were the best. Our efforts for risk management were the best performing things we had in that paper trade account for people to watch. And so yeah, the story of the Maury, so to speak, the moral of the story is, look, it's all about your choice. What do you want to do? Do you like the idea of learning that criteria? Well, then learn the first pillar, fundamental analysis. If you like the idea, if you think, for me, it's an enjoyable process. I like trying to figure out. I don't always get it right. I hate being a rich dad advisor because, I'm not rich dad. Rich dad was the all-knowing, person that had all the answers. I'm just a student like you. So, but I do believe, and so far in my life, I feel very comfortable with finding criteria that I like and at least saying, look, this company's fundamentally sound. And I'm buying this as a business, not a stock most of the time. Now's a great time for trading because the market's so high and there's hard to find value. So trade a little bit and have some fun. But the core investing that I want my kids to inherit, my grandkids to inherit, I want to find companies that are fundamentally sound. And this will be great for us to talk about when we get into the Bitcoin stuff and the DeFi stuff and the buy low, sell high stuff. Maybe you look at that first pillar and decide, yeah, I think Warren Buffett's smart. He's acquiring companies that seem to have good products that people seem to like, that serve many, many people well. Well, I only have a boss. I can't be effective because I can't serve very many people. Buy Coca-Cola, buy a share of Coca-Cola, you're now serving millions of people. Buy shares of McDonald's, you have a company that's already served. It says right on their sign, billions served.
Right.
So this is a great way to think, how can I earn money by serving people like I can own shares in some solid companies? So I don't like diversification. I think it benefits Wall Street. I'm going to put my vote with Cuban. I'm going to put my vote with Buffett. Hopefully I can be in good company there.
Okay, before we wrap up, I do want to make one point, and then I want to use you as the example.
Okay.
Robert does say that there is a time when diversification is best. And he says it's when you diversify amongst different asset classes. And in this, I've heard you talk about, you do stock investing. You also own a business, and you've talked about owning real estate. So you've done you do diversify. You just do it in a different way.
This is a great way to close the show. Is I do diversify with some defense. There is some risk management there too. Let me give you an example. If I look at the consumer price index, I'll make this oversimplified and all the engineers can pick it apart. Whenever you use a metaphor, the engineers pop out and say, yeah, but what about this? It's a metaphor. Okay? It's a very simple idea. And if you work really hard to get the message, you'll get it. If you work really hard to pick it apart, you'll pick it apart. But I look at the consumer price index as a balloon. And on this side of the balloon, it's been steady. We haven't had inflation or deflation. It's been kind of steady. It looks like a nice little balloon. But when we turn around and look at the other side, there's a hole about that big in the balloon with air going out and a pump with the Fed pumping money in. And so air's flowing through the balloon like crazy. We have deflationary things happening, deflationary pressures, making the balloon go smaller. And we have, from the outside, we have inflationary pressures pumping up the balloon from the inside. So, one of the things that I have, and Robert would disagree with this probably, but I have a little bit of cash, not a lot, but a little bit of cash. And I got a little bit of gold, not a lot, but a little bit of gold, depending on what most people think a little bit is. Compared to Robert, I'd say I have a little bit.
Right.
But I do have a little bit of cash, and here's why. As I see that tug of war between inflation and deflation, the reason we're pumping so much money in and it hasn't gotten bigger is there must be deflationary pressures. If printing money is inflationary, and we printed $10 trillion in the last 8 years, and we haven't had, and the consumer price index is flat, that tells me there's deflationary pressure out there. Well, the depression in the 1929 through the 30s was deflationary. People hoarded money, money was valuable, people were selling stuff to get cash. Cash was more valuable. And so I like having some cash for a couple of reasons. Number one, if the deflationary pressures do win, if the bubble bursts, that would be deflationary, right? If the bubble bursts and all the air goes out, it deflates.
Right.
So I have some cash. And also, like Buffett has a lot of cash. Why? Well, when things deflate, and prices drop, right? Prices drop huge because people will give away stuff to get money. That's when an investor can find a lot of bargains, and it's nice to have a little cash on hand to pounce.
Right.
I don't want to be fully invested. Buffett isn't. When things deflate in a big way, that's the opportunity to pop in. And then when it inflates, you get the benefits. So, yeah, I think having some gold, having some real estate, having diversifying across asset classes. But I will say this, I don't own real estate just because I don't want to own all stocks. I own real estate the same way I own stocks. I look at the financial statement of that real estate property. It fits the fundamental analysis. To me, it's just a business. Does it look like a good business? Yeah, it looks like a good business. I think I'll put some money in that there. I can use some debt wisely. Very, very cool. So again, yeah, it is diverse, but it's just criterion. And I have reasons for all this stuff. I'm not saying, well, I just buy a little gold and have a little cash, have a little Bitcoin, have a little of this. I try to at least have some rationale. Doesn't mean I'm right. Doesn't mean I'm right. It just means I have a method that I'm not just going to say, well, I'm going to hire all these basketball players and hope some of them are good, and I know some will wash out. I'm going to try and get the best team, because if I don't do that, I know I've just chosen a team, and I know I don't have some of the best players then. I know I do in that case.
So, Andy, we're going to wrap this up, but once again, the ultimate lesson is you got to get your financial education so you can make the right decisions.
Yeah.
Always is.
Yeah. I mean, if people were to say, well, gee, it seems like every time you guys say the biggest answer is financial education, A, that's a clue, and B, well, that's what we do. We're financial educators. We are going to help people that way. So
right.
If you enjoy it, the thing to take from this is the idea of fundamental analysis. How do you evaluate those? And what does technology do now to help me do that?
All right. Well, thank you, Andy. We really appreciate it.
Thank you, Greg. I appreciate you, brother.
And again, hey, everybody, leave comments. Tell us what you want to learn. Andy's a great teacher. He'd love to help you out.
Thanks much.
All right. Thanks, man. Bye.